What if I told you that your loan was paid the moment you signed and the bank recorded it as an asset and not a liability? Now, in this video, I'm going to show you how double entry bookkeeping proves debt discharges built into the system and how accounting entries reveal the truth about who funded the loan. Now, I've studied banking, commercial law, and also accounting standards, and today I'm pulling back the curtain so that you can see beneath or behind the surface. Now, before we dive into this video, this is not legal advice. This is not financial advice. Make sure you do your due diligence, my baby. You dig me? If you do your due diligence on top of seeing these videos, and when I say due diligence, I mean actually research everything that I'm talking about, then you will have a clear understanding of what's going on behind the scenes. Number two, remember to hit the like button, hit the subscribe button. We want to be at the top of the algorithm so people can see things that people are not talking about. You dig me? So the topic of discussion today is to show the massive fraud that's actually happening, okay? And how banks take advantage of you. How banks are doing things that we may not inherently understand when it comes to accounting and when it comes to getting our loans, but moreover, that double entry bookkeeping that literally is explained in books like The Modern Money Mechanics, that's literally explained in the UCC. Okay, so I'm going to be breaking down those things so that it is more of a clear understanding, so that you'll have confidence to what? Discharge your debt, challenge these banks, and not even think that they are the ones that you are getting over on them for doing debt discharge. Okay, so make sure you stay all the way to the end, because we're going to be dropping game. You dig me? Now, what is double entry bookkeeping? All right. So every accounting entry has two sides, debit and credit. Now let's just talk about what happens when a loan is issued. Okay. The bank doesn't fund it with cash. They actually record it. Number one, a credit means liability to your account. You dig me? And then a debit is an asset for the note you sign. So when you think of credit, credit is the liability to your account. But then when you look at the aspect of debit, that's an asset. All right. So what this means is that very much means that your signature is what actually creates the value and not necessarily the bank's money. You dig me? See, we think that the bank is loaning us money, but they're actually not. They're crediting our accounts, which is a liability to us. And when we have a debit based off of the note that we signed, that is actually an asset that was created. All right. So the bank records your promise to pay as their asset. So the question is, who really created the value? If when you sign that loan agreement, for those of you that are new, a promissory note is a promise to pay, okay? And most people don't understand that a promise to pay is a negotiable instrument. Most people don't know that a promise to pay is also lawful tender. So if you wrote your promise to pay something and you signed it with your beneficiary's signature, that became something that can create value for not only you, but for the bank that you gave your promise to pay to. So they're going to say, okay, well, look, this is a loan agreement. You agreed to pay. No, I didn't agree to pay. I just promised to pay. And my promise to pay was the value. Because let me ask you, what are you going to do with my promise to pay? Are you going to wait for me to pay? Or are you going to take that promise to pay, use it as an asset, and make money off of it? And these are the questions that the banks won't answer. Now, what we're going to talk about is a couple of things. We're going to talk about the GAAP, all right? We're also going to talk about the FASB, okay? And then we're going to also talk about the Federal Reserve guidelines. So what I like to do, I like to pull it up so that you guys can read it for yourself, but I do have my own breakdown in layman's terms, okay? Now, let's start with the GAAP. You dig me? Now, the GAAP is the generally accepted accounting principles, okay? So what happens is when you actually apply for a loan or whatever the case may be, it falls under these guidelines and regulations. And it is a set of standardized rules and practices used to guide the preparation and presentation of financial statements in the United States. It requires consistency, comparability, and transparency in the financial reporting, okay? Which is essential for public companies, but often used by private and nonprofit organizations, okay? So it provides a framework on how assets, liabilities, and revenues should be recognized and measured, okay? It promotes consistency in financial reporting, transparency and accuracy. And what's so funny is these are some of the things that they lack. They lack transparency and accuracy. They lack consistency in reporting, and they don't tell you the framework on how assets, liabilities, and revenues should be recognized. They want you to just assume. You dig me? So that's the GAAP. Just food for thought. So if one says, okay, bet, well, can I hold them accountable to this? Well, absolutely. Absolutely. So let's talk about the FASB, okay? And you can obviously go to their website. Let's just go ahead and pull up FASB 140, which is another section that pretty much requires them to provide information on the financial assets and the servicing of it, okay? It says that this statement provides accounting and reporting standards for transfers and servicing of financial assets and extinguishments of liabilities. Okay, so this is almost like a more of enforcing the GAAP, but it also explains how financial assets can be transferred or securitized. So this is the proof that with your promissory note, they are transferring and securitizing and making money off of it. Well, one will say this can't be happening. Well, it absolutely is, okay? They wouldn't put this there if it wasn't happening, okay? Even me just looking here, it says that a transfer of financial assets in which the transferor surrenders control over those assets is accounted for as a sale to the extent that the consideration other than the beneficial interest in the transfer assets is received in exchange. The transferor has surrendered control over the transferred assets if and only of the following conditions are met. Okay? The transferred assets have been isolated from the transferor but put presumptively beyond the reach of the transferor and its creditors, and even in a bankruptcy or other receivership. Each transferee, or if the transferee is a qualifying special purpose entity, each holder of its beneficial interest has the right to pledge or exchange assets it received. And no condition both constrains the transferee from taking advantage of his right to pledge or exchange and provides more than a trivial benefit to the transferor. And the transferor does not maintain effective control over the transfer assets through either one, an agreement that both entities obligates the transferor to repurchase or redeem them before their maturity, and the ability to unilaterally cause the holder to return specific assets other than through a cleanup call. Long story short, what this breaks down is, number one, the process of transferring and how when they transfer it, they actually give control over to the person that they transfer it to. But also at the same time, when you tie it in with the GAAP and you tie it in with the reporting standards, they must report this information to you. Okay? So then we dive into the Federal Reserve, modern money mechanics. And we talk about modern money mechanics all the time. Modern money mechanics is one of my favorite books because to one that wants to truly know what's happening, all of this, you can talk about the GAAP, you can talk about the FASB, and it seem confusing reading it, whatever the case may be, maybe even a tongue twister, right? But when you go to the Federal Reserve and the modern money mechanics, it really breaks down everything to a science. It breaks it down in math. It breaks it down visually so that you can see it for yourself. And you can go online and you can type in the Federal Reserve, modern money mechanics, money mechanics, and you can find the PDF online. You dig me? You can find this online for free, okay? But one of the key things that it says in the modern money mechanics is that the banks do not lend money. Instead, they create accounting entries, okay? So this whole book pretty much breaks down the back end system of how the banks actually create money and are supposed to lend money, how they borrow money, and how they then give the securities to the people, okay? And how they're able to participate in commerce through people putting in applications, which really dives in some of the laws that we're about to talk about right now. Now, let's also talk about the Federal Reserve guidelines, okay? Now, the Federal Reserve guidelines is essential for evaluating requests to use accounts and payment services offered by the Federal Reserve, and they are based off of 6 risk principles. Okay, now what I want to do is pull up those 6 risk principles. So these principles guide the assessment of the credit risk, the potential loss if a borrower fails to repay; market risk, the possibility of the financial loss due to unfavorable market price movements; liquidity risk, the risk of being able to meet obligations due to difficulty in accessing funds or selling assets; operational risk, the risk of losses from failed internal processes, people, systems, or other external events; compliance risk, the risk of penalties or losses due to not following laws or regulations; and legal risk, the risk of potential issues from unenforceable contracts, lawsuits, and adverse judgments. Okay, so this is what the Federal Reserve risks are. And what happens is banks try to put this risk onto you. Okay, but it doesn't even make sense for it to even apply to you. Okay, because your promise to pay is what is the collateral. Okay, that's an asset to them. All right, so just so we can just move forward, let's just talk about some of the laws that support the truth. Okay, UCC 3-104, negotiable instrument. You want to also pull up UCC 3-401, which is specific to your signature and the definition of signature. We also want to pull up UCC 1-201, which pretty much breaks down the definition of person and the uniform code and the power behind that. We also want to bring up, lastly, and this is what we talked about on a live stream, is 12 U.S.C. 412. Okay, 12 U.S.C. 412 just talks about the application. Now, let's pull these up real quick, just for the record. Boom, negotiable instruments means a unconditional promise or order to pay a fixed amount of money with or without interest or other charges described. Okay, so here it is right here. A promise or order other than a check is not an instrument if at the time it is issued or first comes into possession of the holder, it contains a conspicuous statement, however expressed to the effect that the promise or order is not negotiable or is an instrument governed by this article. Okay, an instrument is a note if it is a promise, and it is a draft if it is an order. Okay, so it's interesting. It says an instrument is a note if it is a promise. Understand me? So if an instrument falls within the definition of both note and draft, and a person entitled to enforce the instrument may treat it as either. Okay, then let's dive into UCC 3-401. UCC 3-401 says that a person is not liable unless they sign. Your signature triggers the obligation. So long story short, the obligation can't be created unless you sign it. So long story short, you are the one that gives the banks the opportunity to create the obligation. And I know it seems like very self-explanatory, but what if I told you that they couldn't even make money unless you signed with your signature? And someone will say, okay, well, yeah, absolutely, you don't trigger an obligation. But yeah, I mean, that's, if I told you that obligation, the definition of obligation is literally guaranteed by the United States, then long story short, you would look at obligation not as you're obligated to pay something, but you'll look at an obligation as more of an asset. You'll look at obligation as more as money. Okay, because it creates money for the banks. Then we dive into 1-201, 16, okay, breaks down the creditor, breaks down contracts. Now, document title includes bill of lading, doc warrant, doc receipt, warehouse receipt, or order for the delivery of goods, and also any other document which the regular course of business or financing is treated as adequately evidencing that the person in possession of it is entitled to receive. See if we'll pull up the definition of person. Okay, it won't do that. All right, long story short, the term person includes a trust, estates, individual. So a trust or entity can also create an obligation as well. Okay, then we dive into 12 U.S.C. 412. 12 U.S.C. 412 talks about the application for notes, collateral required. It says any Federal Reserve Bank may make an application to the local Federal Reserve agent for such amount of the Federal Reserve notes herein provided for as it may require. Okay, so such application shall be accompanied with a tender to the local Federal Reserve agent of the collateral in an amount equal to the sum of Federal Reserve notes thus applied for and issued pursuant to such application. Okay. The collateral security thus offered shall be notes, drafts, bill of exchange, and acceptances required under Section 92, 342, 348, 349, 352, 361, 372, 373. Okay? Of this title or bills of exchange endorsed by a member bank. Long story short, Federal Reserve notes are issued in exchange for obligations. So when you are putting in an application, okay, your application is, and you sign an application, you have created an obligation, you should receive Federal Reserve notes. But the reality is that you really don't do this, okay? I want you guys to understand that what I'm talking about is not conspiracy theories. These things are literally etched in the law, all right? So here's where the discharge happens. If your note is an asset to the bank, why are you repaying it again? It's a question to ask yourself when it comes to the debt discharge aspect. Okay, well, I understand that, you know, Nicholas talks about debt discharge, or I see these concepts out there, but can you really do it? You can ask yourself that question, can you really do it? But I'll just ask you, if your note is an asset to the bank, why are you repaying it? If you know what an asset is, if you know what a note is, then you kind of have your proof right there. Well, they said I can't do that. Well, that's what they want you to know. That's what they want you to think and assume. Well, I can't do it. I sent them letters and this, that, and the third, and they didn't accept it. Well, why would they? If they're making double money off of you, okay? Question is, how does one apply 12 U.S.C. 412? It's not really the application of it. It's really understanding what it is, okay? Understanding that the money comes from your very note, okay? So yes, you're thinking that it's an application of 12 U.S.C. 412, but it's not the application, it's the understanding. So when you understand 12 U.S.C. 412 and the fact that your application is what is creating the money, and then you understand, or a negotiable instrument, you understand what a signature is, you know that you are the one creating the value. So if you're the one creating the value, they really have nothing to stand on or have no type of lawful consideration to say that they loaned you money when they actually didn't. There's another section of this title under 12 U.S.C. 1431, powers and duties of banks. It says that, okay, under 12 U.S.C. 1431, powers and duties of banks, each federal home loan bank shall have power subject to the rules and regulations prescribed by the director to borrow and give securities therefore and to pay interest thereon and issue debentures, bonds, and other obligations. Okay? So it says here that they don't loan you a thing. They just borrow and give it. All right? So it's more about the understanding. So the thing is, when you send a payment instrument, a coupon, or remittance, it actually offsets the bank's liability if done properly. Okay? So understand that the bank already booked the value and your discharge simply balances the books. It's balance. Okay? So in essence, you both have the duty and obligation to discharge the debt. Okay? So understand that debt discharge is not an escape, it's reconciliation. Okay? Now, here's how to use this knowledge. After you kind of understand the knowledge and you have full truth and understanding, this is how you break it down. You want to then use the FOIA or a QWR, which is a qualified written request. I'll show you guys what a FOIA is, okay, which is the Freedom of Information Act. You can pretty much request, the public has the right to request access to the records held by federal government agencies. Okay, this law ensures transparency and allows citizens to see how their government operates. Okay, so they have a duty to give you this information when you request it. And then when you look at a QWR, QWR, qualified written request is a formal letter that a borrower can send to a mortgage servicer to request information about their mortgage loan or dispute an error in the servicing of the loan. Okay, now when you do this, you are demanding the ledger entries under 12 CFR 226, which is essentially under the Truth in Lending Act. Under the Truth in Lending Act, you have a right to ask for the documentary evidence about your loan. Okay? You want to also ask for the merge transfer trail or securitization info. So what happens is if it got transferred or securitized, then they're not the holder in due course. They don't have security interest in whatever the property is, okay? They made their money. They've been made whole. So if they've been made whole, guess what? I'll answer that in a second, okay? Use this information to, number one, prove standing, challenge fraudulent inducement, and establish that payment is already incurred, okay? So when you use this information, you prove the standing, challenge fraudulent inducement, establish that the payment has already occurred. You now are in a position where it doesn't matter about whether you agreed to giving them security interest, whether you agreed to pay them back. It doesn't really matter, okay? Because when you shift the burden of proof and you have them prove that they never got paid, you have them prove that they actually haven't transferred the money, haven't transferred the note, you have them prove that they securitized it, or have them prove where the funds came from, and they cannot prove it, then whatever you have contracted to now is null and void, my baby. So the thing is when you understand how the books are balanced, you stop letting them play you as the debtor, okay? When you let them play you as a debtor, then you will keep thinking that they have given you security interest, or you have given them security interest. They can't have security interest, okay? So the reason why is because you always were the source of the value. You're the one that created the value. They only have security interest if they actually loaned you money. If under 12 U.S.C. 412, under the application, they gave you the Federal Reserve notes instead of giving you the home or the vehicle and then putting in a credit or debits on your account, okay? So now you just have to hold them accountable. When you know this stuff, you just hold them accountable to the laws that you know. It's not that you asking them for permission, but you are essentially, you already know the information, and that they should already know too. They're just not telling you it. They're assuming you don't know. So when you notify them, oh, hey, I do know X, Y, and Z. Can you provide this and this and this to me? And they cannot provide it, which is their duty and obligation to provide this information to you under the FOIA, under the GAAP, which requires transparency. When you dive into, when you ask them, or when you write out a QWR, they have a duty to provide this information to you. So this is the whole premise of what we talk about. We want to shift the burden of proof. We want to challenge these debt collectors. We want to challenge these mortgage companies. We want to challenge these auto loan companies. And again, it's not easy, okay? This is why you can easily be misconstrued. Just because you see Federal Home Loan Bank, I will ask a person, what is a Federal Home Loan Bank? You think that's different? You think that's something different? It isn't. Okay, they're trying to confuse you by putting in some words that the common person doesn't understand. And that's why we're here. That's why we're talking about it, to pretty much get rid of the fluff. You dig me? So the aspect of challenging a debt collector is really knowing exactly what it is that you're challenging. When you know what it is that you're challenging, then you know exactly what to expect from them. It's not that you're going to be sitting there throwing stuff at the wall and hoping that it'll work. No, you're literally going to know exactly what you're asking them for and what you should be receiving. And if you don't receive it, then you just hold them accountable to that. It's non-negotiable. A unconditional offer is a non-negotiable offer. So if I ask you for certain things, and if you don't answer it, then everything stands in truth, or it unsubstantiates your claim of me having to owe you debts or whatever the case may be, then that's what it is. There's no ifs, ands, or buts about it. So become strong in the information. Actually gather the knowledge. The knowledge is the power. Okay? Now, if you want to learn more about this, down below I have the Complete That guide in the description, where you can actually learn, get the letters, things like the QWR. And again, you can create these things on your own. That's why I literally give you the step-by-step process and break down the information in my YouTube videos. Okay. Now, if you're not trying to do that, tap into the Complete That guide down below. You become an affiliate. Number two, if you want to work with me one-on-one, I help people with their credit, help them get started in business, and help them overall make money or get money. Okay. That's what one-on-one mentorship is about. Number three, if you want to follow me on Instagram, tap in with me at biz.nick, tap in with my Twitch. I'm actually live right now. So if you want to see the behind the scenes, tap into the Twitch. You dig me? And my last question is, have you ever wondered how banks make money off of your signature? Comment below your questions. any new laws that we haven't spoke about already, put that in the comment section down below. Let me know what you guys want to learn as well. Remember to like, subscribe, hit the bell, because the knowledge of the books gives you power outside of the courts. I love you guys. Comment the word discharge if you got all the way to the end, and I'm gone.